welcome to the channel Get Rich. Today the company we are going to analyze is Lux Industries Limited. So let's first look into their business and then the financials and finally the valuations. So what's till the end? What are the business they are operating in? So their main business is selling innerwears. So let's have a look at the innerwear market. So the current size of the innerwear market is 27,931 crores, which is estimated to grow at a CAGR of 10% over the next decade to become 74,258 crores by 2027. The market is dominated by a large number of small players, making 60 to 65% of the market unorganized. However, the segment is evolving gradually and moving towards organized retail. Lately, the premium innerwear market in India has been experiencing the increasing entry of global brands, mostly through partnerships and tie-ups with homegrown brands. So let's have a look at men's category and women's category. So the men's innerwear industry in India is marked at 15,000 crores, of which 5,200 crores is dedicated to the middle and premium market segments. So the current market share of men's innerwear segment accounts for a 7% share of the men's apparel market. So the men's innerwear market, which was estimated to be worth 9,477 crore in the year 2017, is estimated to grow at a CAGR of 7% to reach 17,894 crores by 2027. So if you look at the women's innerwear segment, the women's innerwear segment is poised to grow at an impressive 12% over the next decade to 56,364 crore by 2027 from the current market size of 18,454 crore. So let's have a look at their breakdown. So first, let's have a look at the men's innerwear category. So out of the men's innerwear category, 53% is belonging to the economy segment, and then 32% belongs to mid-price category, and then 15% is premium category. So we have a lot of room to grow the premium size category as the people's purchasing power is getting bigger and bigger. Then if you look at the women's innerwear segment, the Indian innerwear market is primarily dominated by women's innerwear, which accounts for 64% of the total innerwear market and accounts for 15% of the women's apparel market. Branded innerwear contributes 38 to 42% of the women's innerwear market, and this share is expected to grow to 45 to 48% by 2022. So currently 60% are unbranded, but that portion is going to shrink and the branded portion is going to increase. That is what expected, and it is projected to be around 45 to 48% by 2022, the branded ones. Then if you look at the price range, so the basic mass range of innerwear priced 60 to 150 rupees. The premium mass range of innerwear is 100 to 250 rupees. The premium range extends from 150 to 400 rupees, while the luxury range extends from 400 to 3000 rupees. So we saw about the innerwear market. Let's dive into the Lux Industries. So Lux Industries, founded in 1957 by late Giridhari Lal Todi as Biswant Hosiery Mills. It was incorporated in 1995. It is one of the largest players in the hosiery business, having a market share of 14 to 15% of the organized men's industry. This Kolkata-based company is managed and headed by the second generation of the founder family. Lux is engaged in manufacturing and sales of products which includes men's, women's and kids innerwear, winterwear, socks and slacks for women in varied colors and design. So if you look at their market rankings, they are the first ranked innerwear company in volume terms. They are the first ranked innerwear brand in Bengal. They are first ranked Indian exporter of innerwear. So that's a huge market position they are having in the current market. If you look at the Lux product quality, so Lux product quality, delivery and service are as per international standards, and thus they are exporting to 47 countries, largely comprising the Middle East, Africa, Australia and Europe. In financial year 17 to 18, it derived 10% of its revenue from export sales. It also offers more than 100 products under its 12 major brands, with focus on growing exclusive retail outlets and in providing customers with a seamless buying experience. The company's products are available in 450,000 retail points spread across India. Lux has extensive vertical integration with one of the lowest manufacturing costs, as 100% of its products are manufactured in-house. It has manufacturing capacity of 2000 lakh garment pieces a year across 6 manufacturing units. The newly established Dankuni plant of the company, having an area of 5 lakh square feet, it is running at optimum utilizations combined with cost efficiency measures. It has helped Lux to improve margins. They enjoy a fill rate of 95% against industry average of 80%. So what is a fill rate? The fill rate is the fraction of customer demand that is met through immediate stock availability without back orders or lost sales. They are also entering into new product like Langre. It is gathering pace and doing pretty well in the market. So let's have a look at their brands. So before having look at their brands, first let's look at their position in the market. Which category they are selling, how much percentage of their revenue is coming from which category. So if you look at their revenues, 34% of revenue is coming from economy segment, 45% are coming from medium premium segment, 21% are coming from premium segment. If you compare that with the industry has around 53% is economy, but they are selling only 34% from economy, which is very good, because if you look at the EBITDA margin of economy segment, they have an EBITDA margin of 8 to 10%. But if you look at the EBITDA margin of medium premium, they have an EBITDA margin of 13 to 15%. If you look at the premium segment, they have an EBITDA margin of 15 to 18%. Remember these EBITDA margins for different segments. I will come back to this later when we are analyzing the financials. So they are doing pretty good than the industry. They are selling more of a premium products and mid-premium than economy, so their EBITDA margins are pretty good. And they are also expecting their premium products to grow at a CAGR of 30% in the next 2 to 3 years. That is huge. So they are going to increase their revenue share from premium segment even more. That is going to give increased EBITDA margin. That is also very, very good for the company. Then let's have a look at their brands. So out of their brands, Lux Cosi is one of the strongest and fastest growing men's innerwear brands, both in economy and mid segment. Lux Cosi Glow is a durable player in the economy to mid brand segment. Lux Venus is one of the largest vest brands in the economy category. Lux Cosi Big Shot is a preferred consumer brand in the boxer and brief segment. On is emerging as one of the most promising mid to premium men's innerwear brands. They are very good in building from a concept to a brand. They have a look at their brands. They have like lot of brands, all are top in the market. It's very, 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 very good for the company. And Lux has also acquired manufacturing and marketing rights of Virat Kohli's brand 18, which will empower the company into the men's premium innerwear, socks and sleepwear segment. So this is also very huge for the company, because 18 is a brand created by Virat Kohli and they are manufacturing various products using different companies. So for shoes, they have tied up with Puma. So it's a very good for the company to tie up with this brand. So it will help them to increase their premium market share. And then if you look at other brands like Lyra, Gen X, the company's merger of JM Hosiery, which owns the men's brand Gen X, and Ebel Fashions, which owns the women's brand Lyra, with Lux is under process, and both of these group constituents are profitable and would prove value and EPS accretive. So these are different companies which are owned by the promoter, and they are going to merge it with Lux Industries Limited. So that is also a very, very good thing for the company. If you look at their advertisement, so they have signed Mr. Amitabh Bachchan as the brand ambassador for their brand Venus. It is one of the largest innerwear brands in India. They have also signed him for their winterwear brand Inferno. They have also signed Mr. Varun Dhawan as the new brand ambassador for Lux Cosi. By signing Dhawan, Lux Cosi is repositioning itself within the young audience. So they are doing a lot of marketing expenditure to get the brands going. So it's a very, very good thing. But also we have to look at how much they are spending in this for these advertisements. So let's have a look at their marketing spend. So if you look at their marketing spend, they spent around 41 crores in financial year 2013. It increased to 56 crores to financial year 2014. It is steadily increasing and it reached around 109 crores in financial 18 and 91 crores in financial 2019. So they have invested a lot into building these brands. They invested 477 crores in their brands across the 7 years ending financial 2019. They are investing around 8% of the turnover every year. And if you look at the Lux profits from every rupee invested in brand spending, it increased from 5.74% in financial 2013 to 7.47% in financial 2019. So it helps them to earn more revenue. So that is good for the company. And then if you look at their manufacturing facilities, so they have manufacturing facilities in 3 different places. So one in Punjab, one in West Bengal, and one in Tamil Nadu, and they have at 6 different places in Ludhiana, Agarpara, BT Road, Dankuna, Dulagrak, and Tirupur. So they have these manufacturing bases in all these places, and they are manufacturing from semi-premium to premium, from men's innerwears to men's and women's outerwear. They are manufacturing 20 crore garment pieces a year, which is one of the largest in the Indian innerwear sector. They have new state-of-the-art 12 lakh square feet manufacturing facility in Dankuni, West Bengal. They did 83 crores investment across 11.48 acres on the outskirts of Kolkata. They have 108 stitching sewing machines from Singapore, 11 high-speed knitting machines from Germany, 60 sock knitting machines from China, and 2 cutting machines from Singapore and Italy. So it explains they have a state-of-the-art facility. So it has the capacity to produce 5 lakh units of finished products a day, and they are also planning to have a phase 2 expansion to double the production capacity over the next 3 to 4 years. They have one of the low manufacturing cost because 100% of their products are manufactured in-house with zero outsourcing. They invested extensively in manufacturing integration and scale with the objective to reduce cost. They are doing all their critical processes done in-house. Lux has concentrated on large technology-driven manufacturing. They are outsourcing processes such as stitching. They are able to keep their asset profile and employee base light because they are outsourcing this stitching. So they are doing 100% knitting, cutting done in-house. They have 350 circular knitting machines, fully automated in-house stitching unit. So these are all about their manufacturing capabilities. Then let's look at their distributors. How do they distribute their products to different peoples? So the company enjoys relationship with more than 950 distributors for over 35 years. The company suffered less than 1% attrition among distributors. So the company is among few innerwear companies to possess 9 exclusive brand outlets and 160 large format stores to showcase the entire product range under a single roof. Currently, there are a lot of e-commerce is coming in. So let's see how they are doing in the e-commerce kind of selling. So they are creating an online presence while enhancing access and availability of its products through e-commerce focused websites. They are available in Amazon, Snapdeal, Myntra, Paytm, Flipkart, ShopClose. They also have other presence in Keep It On, Jabang, Limeroad, Tata Click. So they are having their online presence as well. So that's a very good thing for the company. Then let's look at their global presence. So for financial 2018-19, export contribution to revenue was 11%. It increased the number of countries exported from 22 to 47 over the past 5 years. They did export of 136 crores in financial 2019 and it is expected to reach 175 crores in financial 2020. The company addressed tropical countries with demographics similar to India. So they are exporting to 47 countries, largely comprising the Middle East, Africa, Australia, and Europe. And I also lightly touched up the merger before. So now let's have a look at their merger. So what are the companies they are trying to merge with? Lux Industries. So they are going to merge JM Hosiery and Ebel Fashions with Lux Industries. So if you look at the revenue for the Q3 financial 2020, Lux Industries had 306 crores. And JM Hosiery, they had a revenue of 64 crores. Ebel Fashions, they had a revenue of 66 crores. So in total, they are going to have 436 crores for Q3 financial 2020. So if you look at the JM Hosiery, their revenue increased by 19% in Q3 compared to the previous corresponding quarter in the previous year. If you look at the Ebel Fashions, their revenue is increased by 17%. And then if you look at the 9-month financial 2020 revenues, It increased from 924 crores with Lux Industries, together with 229 crores from JM Hosiery, 210 crores from Ebel Fashions, together 1363 crores. So if you look at the revenue increase, JM Hosiery, they increased around 13% of their revenue from year on year for the 9-month financial year 19 to 20, and Ebel Fashions, they increased their revenues by 12%. So it's a good thing for the company because they are trying to merge with different companies. They are trying to merge it with the Lux Industries, because JM Hosiery also have a very good brand. They have one company as having Genex, which is also a very good brand. Another company, they are having Lyra, which is they are selling leggings for the women's category. So it's a very good thing because they are merging their high growth companies with this Lux Industries. So it's showing the intent of the promoter to grow this Lux Industries well. So that's a very good thing. Also, after this merger, it's going to be EPS accretive. So that's also a good thing for the company. So existing shareholders of Lux Industries don't have to worry about these mergers and valuations. So they did the valuations at the par price. Let's have a look at the growth opportunities. So what are their growth opportunities? So they're at the cusp of rapid growth, because per capita innerwear expenditure is expected to double to rupees 300. Only 20% of the innerwear market accounted for by the premium and semi-premium segments, offering significant headroom for premiumization. Lux On brand is a premium brand growing at 30% every year. Lux Glow in the mid-premium segment, introduced in January 2017, they are also doing very good. Revenues from premium brands increased from 3.9% in financial 2013 to 10% in financial 2019. That's a very good growth. The company plans to market globally a unique collection of socks, innerwear and sleepwear under the brand 18. As I said before, 18 is a brand of Virat Kohli. They acquired the rights to market globally a unique collection of socks, innerwear and sleepwear. It is going to increase their premium segment revenues. So also the other growth opportunity is the company offers a range of products from 38 rupees per piece to 1350 rupees per piece. So that's a very good thing. They are present in all the categories. They have product offerings across ages, genders, geographies and season. They are present in high growth segment of active wear and sports wear. They are present in vest, briefs, trunk, boxers, thermal wear, panties, camisoles, leggings, long wear, t-shirts and socks. So they are increasing their product extension based on the widening customer needs. So they also have pan-India footprint. The company enjoys a wide presence in the northern, eastern and western parts of the country, generating 70% of the revenue from these zones. They also have a growing scope of e-commerce. Growing traction from Africa, Arab countries and Middle East also have some of their growth potential. Also the other thing, they also have a product innovation. So they introduced India's first scented vest. The unique feature of this vest is the fact that they retain their fragrance even after continued washes. They are rolling it out to the market and it's gaining traction. So it's also a very good thing for the company. Let's have a look at their income statement. So their revenue grow about 9% CAGR from financial 2013 to financial 2019. In financial 2013, their revenue was 713 crores. In financial 2019, their revenue of 1218 crores. It grew at the CAGR of 9%. But note that their PAT, profit after tax, was 20 crores in financial 2013, 101 crores in financial 2019. So it grew 31% CAGR from financial 2013 to financial 2019. How do they manage it? Their revenue grow by just 9%, but their profit after tax, which is growing at 31%. How is that possible? So in order to answer that question, let's look at the EBITDA and profit margin. So in financial 2013, they have a EBITDA margin of 6.3%. Financial 2019, they have a EBITDA margin of 15.6%. Look at the growth. They changed from 6.3% EBITDA margin to 15.6%, which is a huge increase in EBITDA margin. Even though their revenue is doing at a less growth, their PAT did well with 31% because of this EBITDA margin expansion. If you look at their EBITDA, it also increased from 45 crores to 189 crores in financial 2019. It increased by 27%. Cash PAT, it increased by 29%. EPS, which increased by 31%. So this is a very good growth. So they are growing at 31% in the bottom line. So for those who don't know what is bottom line, it's a net income of the company which grown by around 31%. That is huge thing for the company. But then we have to analyze that can they able to maintain these kind of growth in the future. As far as I see, their revenue is increased by 9%, but then just because their EBITDA margin expanded, they did the PAT of around 31%. So we have to analyze, do they have enough opportunity to expand their margin further? So we looked at the starting of the slide, the EBITDA margin of different product segments. So the highest margin, which is from the premium segment, it's around 15 to 18%. They are already at 15.6%. How much they can do better? So they can go at around 18-19% maximum. They cannot grow like 6% to 15% like they grow. They cannot grow like 15 to 25-30. No, it's not possible. The maximum is like 18 to 20%. So they don't have much EBITDA margin expansion further. So that's the problem. So they cannot grow their profit after tax at this rate in the future. So that's the main thing we have to consider in the valuation. So then in 9 months, financial 2019 to financial 2020, they increased their revenue by 12%. So their EBITDA increased by 18%. Profit after tax increased by 49%. So it's because of EBITDA margin expansion by 80 bips. PAT margin expansion by 250 bips. So just because of this margin expansion, they are doing very good in profit after tax. Then let's have a look at their balance sheet. So they are having their total assets of 124 crores in March 2008, and now they have 803 crores in March 2019. It's a very good growth. They are increasing their total assets. But then if you look at the borrowings, they have around 180 crores in March 2019. So they decreased debt a bit. That's also a good sign. Then if you look at their return on equity, they are doing around 26% return on equity. So that's a very good thing for the company. So their return on capital employed, it's around 28%. It's a very good number. So if you look at their net debt to equity, it's 0.4. That's not very good, but then it's still, they are not over leveraged in their balance sheet. So it's also a good thing. So if you look at their competitors, so their main competitor is Page Industries, who sells Jockey brand. And also they have two more competitors. A lot of people are asking, is Lux Industries is going to be the next Page Industries? Because Page Industries created tremendous wealth, but are they going to be the next Page Industries? Yeah, the answer is they cannot grow like Page Industries as far as I see, because they are growing at 9%. The Page Industries was growing at 19-20% in sales, but they are not growing at that point. Even the management commented that they are going to grow at 10 to 12%. And their margin is going to be around the same. So I don't see they can grow like Page Industries and they can create wealth like Page Industries. That's my personal opinion. You can have contradicting thoughts. If we look at the shareholding pattern, so the promoter shareholding pattern decreased a bit. So they were holding at 74 or something, and now they are having 69.51 because they reduced their shareholding by 4.7% or something. But then there is a reason behind that. So they are holding at around 74%. They want to merge their other companies like JM Hosiery and Abel Fashions into the Lux Industries. So they will get shares from Lux Industries. So it will increase their shareholding higher than the regulatory threshold. So they had to sell 4.74% of the shares so that they can merge those companies with Lux Industries. Then their shareholding pattern will be less than the regulatory threshold. So once the merger is completed, their promoter shareholding is going to go back to 74%. So that's nothing to worry, that promoter is selling. And then if you look at the institutional holding, FII plus DII, it increased from 3.58% to 7.2% in December 2019. It still increased to around 8% in March 2020. Look at that, institutions are buying Lux Industries. They are seeing value in the company because recently the share price got thrashed a lot. So it's selling at 16 PE. Historically, it was selling at around 35, 40, 50 PEs. Now currently they are selling at around 16 PEs. So that's a good short-term opportunity or even the long-term opportunity with less growth. So let's have a look at the valuation. So the revenue in financial 2019, it's 1078 crores. And in financial 2020, 1300 crores. I am projecting it to grow at around 10% for the next 3 years. So their revenue for financial 2021 is 1434 crores. 1,578 crores for financial 2022, 1,736 crores for financial 2023. Also, they have a net profit of 78 crores in financial 2018, 101 crores in financial 2019, 133 crores in financial 2020, 146 crores in 2021, 163 crores in 2022, 180 crores in 2023. Also, net profit is going to grow at 10%, 11%, and 11%. So the current valuation, which is around P 17, so the stock is trading at around P 17. So with that valuation, in 1 year it's going to reach 982 rupees, 2 years 1092 rupees, 3 years 1208 rupees, with the price cumulative growth of 10% for 1 year, 22% for 2 year, 35% for 3 year. But then historically they were selling at huge high valuations because they are in the consumer category. So a lot of stocks are quoting at a very high valuations. So if you want to have your exposure in consumer companies, and if you are looking at for value buys, this company is one of the very good value buys at the current scenario. But then don't expect this company to do a 20%, 25% growth. They are going to do a 10 to 12%, and their EBITDA margin is going to stay at the same rate. It's a very good company having very good market share with very high moat. So they have a lot of good brands. So the price target I am estimating is PE 25. So with PE 25, the price target I am estimating is for 1 year 1318 rupees, 2 year 1444 rupees, 3 year 1606 rupees, with the price cumulative growth of 48% for 1 year, 62% for 2 year, 80% for 3 year. But then one reason I won't buy this stock is I am expecting companies with growth rate of 20-25%. So this company cannot match my expectations because I am expecting the companies to grow at more than 20%. So this company can grow at around 10 to 12%. That's the only reason I will not buy this stock for the long term. Maybe for short term play, to have a re-rating of PE from 17 to 25 or even 30, you can have a, yeah, I can consider buying this company, but it's a very good company, you can buy it. So that's my personal opinion. Of course, you have to do your due diligence before buying any stock. So that's all for today. Thank you for watching. If you want me to do other companies analysis, please mention them in the comment. I will add it into my watch list. Okay, thank you for watching and have a nice day. Bye bye.